If you are approaching retirement and still trying to figure out when to start your CPP, this video is for you because the decision you make about when to begin your Canada pension plan is one of the most permanent financial decisions of your entire retirement. You make it once. You cannot change it. And the difference between your options is not small. If you delay CPP from age 65 to age 70, your monthly payment can increase by up to 42% permanently for the rest of your life, adjusted for inflation every single year. But here is the part most videos skip, that 42% does not apply to everyone the same way, and waiting until 70 is absolutely not the right answer for every Canadian. For some people, starting at 60 makes complete sense. For others, waiting is one of the best financial moves they will ever make. By the end of this video, you will understand exactly how CPP is calculated, what the real difference looks like between starting at 60, 65, and 70, who benefits most from waiting, who should consider starting earlier, and what the most common mistakes Canadians make with this decision. Stay with me through the full video because I am going to show you a comparison near the end that most Canadians never see before they make this choice. Welcome to Canada Pension Map. This channel covers Canadian government retirement benefits, pension rules, and income planning for Canadians approaching or already in retirement. Everything you hear today is based on official government sources and verified 2026 figures. There is nothing to buy, no product, no recommendation to call a number. Just the information, clearly explained. Drop a comment below and tell me what age you are currently planning to start CPP. I genuinely read every comment and your question might become a future video. Now let us start from the beginning. What is CPP and how does it actually work? The Canada Pension Plan is a contributory retirement program. That means it is funded by contributions you and your employer make from your paycheck every year you work in Canada. If you are self-employed, you pay both the employee and employer portions yourself. CPP is not a fixed amount that everyone gets equally. Your monthly CPP payment depends almost entirely on two things: how much you contributed over your working life, and when you decide to start collecting it. To contribute to CPP, you need to be at least 18 years old, earn more than $3,500 per year, and work in Canada outside of Quebec. Quebec has its own separate program called the QPP, but it works in a very similar way. The maximum amount you can earn CPP contributions on in 2026 is $74,600 per year. This is called the year's maximum pensionable earnings, or YMPE. If you earn above that amount, your extra earnings above that line do not generate additional base CPP. However, in 2024, the government introduced a second tier called CPP2. If you earn between $74,600 and $85,000, there is an additional 4% contribution on that portion. This CPP2 enhancement will gradually add to the pensions of Canadians who are working today and earning in that range, but it does not significantly affect those who are already retired or close to retirement. CPP adjusts once per year every January based on the Consumer Price Index, which is simply a measure of how much everyday things cost compared to the year before. This inflation protection is one of the most valuable features of CPP. It means your purchasing power is protected for life, no matter how long you live. Now let us talk about how your personal CPP amount is actually calculated. How is your monthly CPP payment calculated? Your CPP payment is based on your earnings history and contribution years. The government uses your best earning years to calculate your average income over your working life and then converts that into a monthly benefit. To receive the absolute maximum CPP, you generally need to have contributed at the maximum level for approximately 39 years of your working life. Most Canadians do not reach that maximum because of career gaps, part-time work, periods of self-employment at lower income, years spent raising children, or years living outside Canada. The maximum CPP retirement pension at age 65 in 2026 is $1,507.65 per month. But here is what most people do not realize. The average new CPP retirement pension in 2026 is approximately $925.35 per month. That is significantly below the maximum because most working Canadians have years in their history where they earned below the maximum. There is also a helpful provision built into CPP called the dropout provision. The government automatically removes your 17 lowest earning percent of months from your calculation. This protects people who had low income years early in their careers, took time off, or had periods of illness. There is also a child rearing provision that can drop out years when you were the primary caregiver for a child under age 7. The single most important and most controllable factor in your CPP calculation is the age at which you decide to start collecting. Let me walk you through what that looks like at each age. CPP at age 60. You can start CPP as early as the month after your 60th birthday. But starting early comes with a permanent reduction. For every month you start CPP before your 65th birthday, your monthly pension is permanently reduced by 0.6%. If you start at exactly age 60, that is 60 months before 65, which means a total permanent reduction of 36%. Using the 2026 maximum as an illustration, a senior entitled to $1,507.65 at age 65 would receive approximately $964.90 per month if they started at age 60. And remember, this is using the maximum as an example. Most Canadians receive less than the maximum. If your personal estimated CPP at age 65 is, for example, $900 per month, starting at age 60 would give you approximately $576 per month instead. That reduction is locked in for life. When you turn 65, your payment does not go back up to the full amount. You keep the reduced amount, adjusted for inflation, forever. Why would someone choose to start at 60? There are legitimate reasons. If you need the income now because you have stopped working and have very little in savings to bridge you through, waiting is simply not an option. Cash flow today matters more than a larger check tomorrow. If you have a serious health condition that affects your expected lifespan, starting early often results in more total lifetime income. The math on that depends entirely on how long you live. If you have a physically demanding job and your body simply cannot continue working until 65, starting CPP at 60 is a reasonable and sometimes necessary choice. And if you have significant high-interest debt, the guaranteed income from starting CPP early can be more valuable than the future benefit of waiting. CPP at age 65. Age 65 is the standard starting age for CPP. You receive the full calculated amount based on your contribution history with no reduction and no enhancement. It is the baseline. Most Canadians historically started CPP at 65 simply because that was the default retirement age and because it aligned with the start of OAS. That is still a perfectly reasonable choice for many people. At age 65, you also become eligible for OAS, which provides an additional layer of retirement income on top of CPP. For seniors with modest total income, GIS may also become available, which can add up to $1,109.85 per month on top of OAS in 2026. One thing worth knowing is that CPP income counts as taxable income on your return. If your total income from CPP, OAS, and other sources exceeds approximately $93,454 based on your 2025 tax return, the government begins recovering a portion of your OAS through what is called the recovery tax. Starting CPP at 65 when other income is already high can sometimes push people into that territory. This is one reason why the CPP timing decision cannot be made in isolation. If you are in average health with average life expectancy, starting at 65 is a reasonable baseline to compare against the other options. CPP at age 70. Now let us talk about the option that most people click on this video to understand, delaying CPP until age 70. For every month past age 65 that you delay CPP, your monthly pension increases permanently by 0.7%. Delaying all the way to age 70 means 60 months of enhancement, for a total permanent increase of 42%. Using the 2026 maximum as an illustration, a senior entitled to $1,507.65 at age 65 would receive approximately $2,140.86 per month starting at age 70. That is a difference of $633.21 every single month for life, adjusted for inflation every January. But again, these are maximum amounts. If your personal estimated CPP at age 65 is $900 per month, delaying to 70 would bring that to approximately $1,278 per month. Still a meaningful increase, but a different number than the maximum examples you sometimes see. The 42% enhancement applies to your personal CPP amount, whatever that is. It does not mean everyone gets $2,000 per month. Now here is the trade-off. To benefit from the higher age 70 payment, you need to live long enough to collect it in meaningful amounts. During the 5 years between 65 and 70, while you are waiting to start CPP, you are not receiving any CPP payments at all. That is 60 months of payments you did not take. The point at which your cumulative lifetime CPP income from waiting equals what you would have received by starting earlier is called the break-even age. Based on 2026 figures, the break-even age for comparing starting at age 65 versus starting at age 70 is approximately age 82 to 83. This means that if you live past approximately age 83, you will receive more total lifetime CPP by waiting until 70. If you live past 83, the higher monthly check more than makes up for the 5 years of missed payments. Canadian average life expectancy today is approximately 82 to 84 years for a 65-year-old Canadian. That means for a healthy senior in average or better health, the break-even math often lands in a favorable place for waiting, but these are averages and your situation is your own. Who should seriously consider waiting until 70? There are 4 groups of Canadians for whom delaying CPP to 70 often makes strong financial sense. The first group is seniors in good to excellent health with a family history of longevity. If your parents or grandparents lived into their late 80s or 90s and your own health is reasonable, the probability of living well past the break-even age is meaningfully higher than average. The longer you live, the more the higher monthly payment pays off. The second group is seniors who have other income to live on between 65 and 70. If you have RRSP savings, TFSA money, a workplace pension, rental income, part-time employment, or a spouse's income, you may be able to cover your living expenses without CPP during those 5 years. This is sometimes called a bridge strategy. You draw down your registered savings from 65 to 70 while waiting for CPP to grow, and then the larger CPP check replaces some or all of that income. The third group is seniors who want to manage their OAS clawback risk. This is a strategy that most people never consider. If you have a large RRSP or RRIF, and you are being forced to make minimum withdrawals from it, delaying CPP and drawing down your registered savings faster in your mid to late 60s can actually help. You melt the RRIF balance down during those years and then layer the larger CPP payment on top when the registered funds are smaller. This can reduce your lifetime tax bill significantly. The fourth group is single seniors, or seniors whose spouse has a much lower income. CPP has a survivor pension feature, but the survivor pension only pays a portion of your CPP to your spouse after you pass away. It is not a full transfer. Seniors without a spouse to depend on financially have a stronger incentive to build the largest possible monthly pension from CPP because there is no backup income stream if their own income falls short. Who may be better off starting CPP earlier? This is the part of the conversation that does not always get equal attention, and it is just as important. If your health is already significantly affected by a chronic condition, or if your family history points to a shorter life expectancy, Waiting until 70 may mean that the higher monthly payment never has enough time to make up for the missed payments from 65 to 70. In that situation, starting at 60 or 65 often results in more total lifetime income. If you have stopped working and have no meaningful savings or other income to live on, waiting simply may not be possible. Your retirement needs today are real. A guaranteed income starting now is more valuable than a hypothetically higher income starting 5 years from now. If you are in a higher income household where your income from all sources is already approaching the OAS clawback zone, adding a larger CPP payment at 70 might increase your total annual income enough to push you further into the recovery tax range. In some households, starting CPP earlier at a lower amount and combining it with strategic RRSP or RRIF drawdowns results in better after-tax income over the retirement period. This requires careful calculation and often a conversation with a tax professional. If you have a spouse with a much higher CPP than you and you are in lower health, having you start early and them delay later can sometimes be a better combined household strategy than both waiting or both starting early. There is no single answer that works for everyone. The most common mistakes Canadians make when choosing their CPP start age. The first and most common mistake is deciding based on what friends or family did rather than running their own numbers. Your sister started at 60 and your neighbor waited until 70. Neither of those decisions tells you anything about what is right for your contribution history, your health, your other income, and your life. The second mistake is looking at the monthly payment amount without considering the break-even age. Seeing $2,000 per month at age 70 sounds impressive, but if you live only to age 78, you would have received more total income by starting at 65. The third mistake is ignoring the tax consequences. CPP is fully taxable income. Starting CPP while still working and earning a high salary can push you into a higher tax bracket. For some Canadians, delaying CPP until they have fully retired and their income has dropped significantly results in a lower tax rate on every CPP dollar they eventually receive. The fourth mistake is forgetting about the survivor pension impact. If you take CPP early and pass away before your spouse, the survivor pension your spouse receives is calculated based on your CPP amount. A lower CPP because you started early can mean a meaningfully lower survivor pension for your spouse later. The fifth mistake is not checking your own Service Canada statement before making the decision. You cannot plan properly using the maximum CPP figures from articles or videos like this one. Your actual estimated CPP at age 60, 65, and 70 is available for free through your My Service Canada account at canada.ca. Those are the numbers you need to run any meaningful calculation. Log in. Find your statement of contributions. Look at your estimated monthly CPP at each age. That is where your planning should start. Let me bring all of this together. Deciding when to start CPP is not a simple calculation, and it is not a one-size-fits-all answer. Here are the key things to hold on to from this video. The standard CPP age is 65. Starting before 65 permanently reduces your payment by 0.6% per month, up to 36% at age 60. Waiting past 65 permanently increases it by 0.7% per month, up to 42% at age 70. The 2026 maximum CPP at age 65 is $1,507.65 per month. The average is approximately $925.35. Your personal amount depends entirely on your contribution history. The break-even age for comparing age 65 versus age 70 is approximately 82 to 83. If you live past that age in good health, waiting typically results in more total lifetime CPP income. If you have a shorter expected lifespan or need the income now, starting earlier often makes more sense. The decision also intersects with your OAS start date, your RRSP and RRIF drawdown strategy, your tax situation, and your spouse's circumstances. It should not be made in isolation. Before making this decision, log into my Service Canada account at canada.ca and look at your personalized CPP estimate at age 60, 65, and 70. Then consider your health, your other income sources, your tax situation, and your household context. If you are unsure, a conversation with a qualified financial planner who specializes in Canadian retirement income can be worth every minute. There is a lot of money at stake in this decision, and getting it right for your specific situation matters. If you found this video useful, please subscribe to Canada Pension Map. Every week, this channel publishes clear, detailed, and accurate content on Canadian government retirement benefits, CPP, OAS, GIS, and retirement income planning. No sales pitch, no product, just reliable information for Canadians planning their retirement. Drop a comment below and let me know what age you are currently planning to start CPP, or if you have a question about your specific situation. I read every comment, and if you want to go deeper, watch the next video on how CPP interacts with OAS and why starting CPP at the wrong time can quietly reduce your OAS through the recovery tax. That video is linked in the description. Thank you for watching Canada Pension Map. Take your time with this decision. It is one of the most important ones you will make.